As bullish as it is that Ethereum staking has now been unlocked, and the fact that this is going to spur a competition in liquidity staking tokens that will benefit us all, there's a huge chance that we could be revisiting some mistakes of not too long ago, 2021 Anchor Protocol. Also, which exchange is going to be dumping Ethereum because they have to, not because they necessarily want to. That's what we're getting in today's episode. If you guys enjoy it, hit like and subscribe. If you want to know where we are staking our Ethereum, if we are staking or unstaking it, and what coins we're buying that are actually performing quite well and we're awfully bullish on in the next several months, you got to check out the CT Club. A link for that is down below in the video description. Let's get into the video. First off, we have to know that Kraken is first on the list. They're representing 62% of all Ethereum that is waiting to be withdrawn from the smart contract. And that is because, if you guys forgot, they actually were hit with a lawsuit from the SEC saying that their staking program violated their securities laws. And Kraken settled, paying up $30 million to the SEC. So that's why Kraken has to unload this Ethereum. It's not the vast majority of people who are staking, it is the exchange itself out of a legal obligation. So that's first and foremost. Also, what we need to know is that so far, it's 695,750 Ethereum, I think right now, that is in line to be withdrawn from staking. 17.5 million Ethereum is still sitting there staking, not to mention the fact that any rewards and any Ethereum that is in that smart contract staking is sitting at $1, if you're looking in dollar terms, at a loss compared to when most people started to stake. So it doesn't make a whole lot of sense. There's not a whole lot of greed happening that people want to get a hold of this Ethereum to dump it if it's at a lower price than when they first started staking. So maybe that's going to change in the future. But like Toby and I have been saying for a long time now, is that now that there's no staking, there's no lockup period for Ethereum staking, there's not going to be a lot of fear and uncertainty for people holding them back to wanting to gain some kind of passive income for a coin that's pretty much proven itself. Yes, proof of stake is a big change for Ethereum, but dude, it's number 2. It's the most heavily prevalent smart contract blockchain we have out there. This is an article from Blockworks. They had a great article talking about the new war that the Shanghai upgrade is going to release upon us in terms of liquidity staking tokens. You know, Lido had their liquidity tokens. A lot of these staking platforms were granting people liquidity of their stake with this, previously unknown unstaking period. They wanted to help people have some peace of mind, like, listen, even though you can't necessarily get your real Ethereum back, here's this liquidity token. Now that industry exists now, liquidity staking is a thing. And now that unstaking Ethereum is much more, number one, affordable, and number 2, reliable, there's going to be a war of liquidity staking tokens. So much like we saw, this article was talking about Curve and how that saw this kind of war of platforms trying to get the most total value locked, trying to get the most market share for, let's say, being liquidity providers and stable coins on Curve. Now we're going to see a competition of these liquidity protocols and their liquidity staking tokens. And who's going to benefit from this? Us, the end user. We're going to see competition that's trying to provide products and platforms and tokens that will suit us best by giving us the most profits. But as good as that is, there is something that we should all be aware of. Let us not forget what happened with Anchor Protocol. That was an awfully valuable, profitable way to stake a token, a stable coin, UST. Remember, we were getting 20% APY on Anchor for several months. So here's the lesson that we should always have in the back of our mind after going through that shenanigan is please try to keep an eye on where these profits are coming from these liquidity providers, these staking tokens. Is it sustainable? Is it just an emission of coins that will expire in the future? What happens when those incentive models expire? It's going to unravel, much like what happened with Anchor Protocol. So there are some things that probably will be very profitable in the beginning, and it is your choice to take on that risk or not. But be very wary of anything being long-term and forever unsustainable, especially if it seems too good to be true. If there's like an outlier on the profits that one platform is granting compared to what maybe the market conditions would naturally allow. That's my takeaway for today. Let's avoid a next catastrophic anchor protocol moment in crypto, shall we? Let's be better investors and see this space get better. So anyway, thank you for watching. Hit like and subscribe. We'll see you tomorrow. Bye, guys.